Hello and welcome to our next video. This one will be about analytical procedures. It's the next in the series of our express videos related to the paper of Foundations in Audit, being part of the ACCA's FIA qualification. Now, this video will be slightly different to all the other ones. It is still based on the express notes, which you can download from website www.theexpgroup.com. Yet this one is not really based on any particular page or any particular chapter of the notes. This video will be about analytical procedures, which feature in a number of phases of the audit, and therefore they require a special attention. Let's look at the definition of analytical procedures. This is not a formal definition, but in my view quite a good one. In the notes you will actually find a formal definition. This one is a little bit more comprehensive, and the reason for this is to make everything absolutely clear. So analytical procedures is the analysis of amounts, trends or ratios in financial statements and comparing it to auditors' expectations. Alright, now let's take an example of how we can use the analytical procedures before we decide when we can use them. Now, imagine you audit a business that trades Christmas tree. Definitely what you would expect is very little business in the first months of the year and then a rapid increase somewhere in early December. So the pattern of revenues over time would be something like this, with a sharp drop right after Christmas. So that would be January through to November, and then would be December. That would be your expectation as to how revenues should be generated by that business. Now, as an auditor, you go to the client and you see what is the actual pattern of revenues. And if it does suit your expectations, then it is likely that transactions are recognized properly. You can't yet conclude, obviously you need to do some other procedures. However, you made your first step. On the other hand, if for some reason you see a pattern like this, you start worrying that maybe revenue is not allocated to the proper period. Maybe some of last year's revenue was recorded only this year and reported only this year. Now that would obviously not be appropriate. Therefore, analytical procedures is a very strong procedure that an auditor follows. It is very useful in a number of phases of the audit. Analytical procedures are used at the planning stage. They are used during the execution stage and at completion stage. Analytical procedures are useful for planning because they are a useful tool for risk assessment. Going back to our Christmas tree example, an actual pattern like this indicates a risk of cutoff problem. revenue not being assigned to the proper period. Therefore, analytical procedures are definitely used during the planning phase because they help the risk assessment process. Then during the execution phase, they are used and they're called substantive analytical procedures. Yes, actually some audit tests can be performed by analytical procedures. Usually, in most cases, there will not be enough to allow the auditor to issue an opinion on the assertions in the financial statements. However, there will always be a useful tool for limiting the other substantive work, the test of details. When could it be useful? Now again, if you know that by the price list and by the cost cards, you know that the margin on product is approximately 20%. Again, if you look at the pattern of the margin generated from January to December, and if it is actually at the level of 20%, you may have a preliminary conclusion that the cost of sale is recognized correctly in line with revenue. On the other hand, if in the first or last month of the year the margin would be different, that could also indicate a cut-off problem. One of the most common tests for the appropriateness, the correctness of the calculation of a deferred tax is the calculation of effective tax rate. That is all financial statements tax charge, both deferred and current, divided by financial statements gross profit. If it is largely equal to nominal tax rate, and this particular company or this particular business does not have a lot of permanent differences between the tax base and profit, then it is an indicator that the deferred tax is calculated correctly. Alright, so these are the two examples of the application of substantive analytical procedures. And finally, in the completion stage, where you have all your proposed adjustments, all the misstatements, you've got them all listed, and some of them were introduced by the client into the financial statements, some of them were not. You look back into the financial statements and ask yourself an informal question. Do the financial statements make sense? It's an ultimate question where you ask yourself, is this what I wanted? Would this be something I could sign saying they give a true and fair view? So again, just let me conclude here. Analytical procedures are extremely important, used at least 3 times during the audit, and they are the analysis of amounts, trends and ratios, and comparing it to auditors' expectations.